Here's the brutal truth nobody wants to tell you. 90% of traders lose money not because the market is rigged, but because they trade with an amateur's identity while expecting professional results. You chase every setup, risk too much per trade, and hold losses while cutting winners. You're busy being busy instead of being profitable. This isn't a market problem, it's an identity problem. And it's costing you everything. The difference between the 10% who consistently profit and the 90% who consistently lose isn't intelligence, education, or access to better information. It's identity. The moment you understand this distinction, your entire trading career transforms. Jesse Livermore discovered this the hard way, after losing millions multiple times throughout his legendary career. The man who made fortunes predicting the 1907 panic and the 1929 crash also went broke 4 separate times. Each bankruptcy taught him the same lesson in different ways. The difference between his failures and his legendary comebacks wasn't new strategies or better indicators. It was identity. Amateurs predict where the market will go next. They look at charts and see patterns that confirm what they want to happen. Professionals confirm what the market is actually doing. They wait for the breakout to occur and prove itself before committing capital. Amateurs hope their losing trades will come back. They widen stops, average down, and hold positions longer than planned because admitting a loss feels like admitting failure. Professionals cut losses fast and clean, understanding that being wrong about direction doesn't make them wrong about process. Amateurs stay busy because activity feels like progress. They're always in the market, always watching, always trading, confusing motion with advancement, and mistaking screen time for skill development. Their accounts show dozens of trades per month, each representing another attempt to force profits from unwilling markets. Professionals stay patient because waiting is a position. They understand that not trading is often the most profitable thing they can do. Their accounts show fewer trades, but each represents a carefully selected opportunity where the odds heavily favor success. This isn't conservative trading, it's surgical precision. The next 21 days will rewire your trading brain through 3 distinct phases that address the core identity issues destroying most trading accounts. Days 1 to 7 focus on risk mastery, learning to size positions mathematically rather than emotionally. This isn't about conservative position sizing for the sake of being conservative. It's about mathematical precision that allows you to survive any single mistake while still capturing meaningful profits when you're right. Days 8 to 14 introduce the confirmation protocol, the systematic approach professionals use to enter positions only after the market proves their thesis correct. You'll learn to identify what Livermore called pivotal points, and more importantly, how to wait for confirmation before committing capital. Days 15 to 21 develop professional patience, the advanced skill of building positions systematically rather than betting everything on single trades. You'll learn Livermore's pyramiding principles and develop the psychological discipline to add to winners while cutting losers fast. Here's what's different about this approach. We're not teaching you to trade more. We're teaching you to trade less, but with surgical precision. Livermore made his fortune by refusing 95% of opportunities and capitalizing on the remaining 5%. He would study dozens of stocks, identify a handful showing professional characteristics, then wait for the perfect entry on just 1 or 2 positions. The amateur sees this as missing out on profits. The professional sees this as capital preservation and opportunity cost management. Counterintuitive promise. By the end of 21 days, you'll make fewer trades but keep more money. Your trading frequency will drop significantly, but your win rate and average winner size will increase dramatically. You'll feel bored sometimes, and that boredom will be your edge. While amateurs are getting chopped up by market noise, overtrading their accounts, and forcing opportunities that don't exist, you'll be waiting for pivotal points, the moments when the market tips its hand and shows you exactly where it wants to go next. Think like a hunter, not a tourist. You don't take every photo opportunity. You wait for the shot. The market rewards those who can wait through dull hours and strike in the one clear minute. Livermore called it tape reading, but he wasn't predicting. He was listening. Volume expands, ranges widen, pullbacks get shallow. The character changes at the pivotal point. You don't need to outthink it. You need to see it, then align your risk. But before we can build professional habits, We must fix the fundamental leak that sinks 90% of trading accounts before they ever get started. It's not what you think it is, and it's definitely not what your broker wants you to focus on. This leak isn't about entry timing, exit strategies, or market analysis. It's about something much more basic, much more mathematical, and much more deadly to amateur accounts than any market crash could ever be. The leak isn't your entry timing or your exit strategy, it's your position sizing. Amateurs pick a stock, decide how many shares feel right, then figure out where to put their stop. That sequence is backwards, and it's why they blow up. They see a setup they like, check their buying power, and think, I can afford 500 shares, or let me buy $2,000 worth. The stop loss becomes an afterthought, placed wherever it won't hurt too much rather than where the setup actually becomes wrong. This approach guarantees eventual account destruction because it prioritizes comfort over mathematics, feelings over facts, hope over discipline. Professionals invert the process completely, and this inversion is what separates the 10% who consistently profit from the 90% who consistently lose. They define their risk in dollars first, place their stop at technical invalidation, then calculate position size mathematically. This isn't theory or conservative advice. This is survival. The professional looks at the same setup and thinks, I'm willing to risk $50 on this idea. Where does this setup become wrong? How many shares does that math allow me to buy? Position size becomes the result of risk management, not the starting point of trade planning. Jesse Livermore learned this lesson through multiple bankruptcies. Each time he lost millions, it wasn't because he couldn't read the tape or identify opportunities. It was because he risked too much on individual ideas, allowing single trades to destroy months of careful work. Here's the exact protocol for days 1 to 7, and you must follow this religiously without exception. Step 1. Define 1R, which stands for 1 unit of risk. Risk exactly 0.5% of your account per trade. No more, no less. With a $10,000 account, that's $50, maximum loss per trade. With a $50,000 account, that's $250 maximum loss per trade. This isn't conservative, it's mathematical. At 0.5% risk per trade, you can survive 200 consecutive losses before your account reaches zero. That's not just unlikely. It's statistically impossible if you're following any reasonable system. This buffer gives you the psychological freedom to execute your rules without the paralyzing fear of ruin. Step 2. Identify your stop loss at technical invalidation, not at comfort levels. Below the swing low that created your setup, under the breakout level that triggered your interest, beyond the trend line that, if broken, changes the character of the move. Wherever the technical reason for your trade becomes wrong, this stop placement has nothing to do with how much money you're comfortable losing, and everything to do with where the market proves your analysis incorrect. If the technical stop creates more risk than your 0.5% allows, you don't widen the stop. You skip the trade entirely. The market doesn't negotiate. Neither should you. Step 3. Calculate position size using this mathematical formula that removes all emotion and guesswork from the equation. Shares equal dollar risk divided by entry price minus stop price. Let's work through a real example. Entry at $100, stop at $97. Risk per share is $3, with $50 maximum risk from your 0.5% rule. You get $50 divided by $3 equals 16.67 shares. Since you can't buy fractional shares, you round down to 16 shares maximum, not 17 shares because you like round numbers, not 20 shares because you want to make more money, exactly 16 shares because that's what the math dictates. This calculation ensures that no matter what happens, your loss cannot exceed your predefined $50. The math tells you when to stand aside too. If the distance to your technical stop is too wide for your risk tolerance, the market is telling you this isn't your trade. Step 4. Use hard stops with no exceptions, no widening, no hoping, no second chances. When your stop is hit, you exit immediately without debate or negotiation. The stop isn't a suggestion or a guideline that can be adjusted when convenient. It's a contract you make with yourself before emotions get involved. Amateurs treat stops as starting points for negotiation. They widen stops when price approaches, hoping for a bounce, turning small, planned losses into account-damaging disasters. Professionals treat stops as mathematical certainties that execute automatically. This unwavering discipline separates consistent profitability from emotional trading. Sarah proved this transformation is possible. She had a $15,000 account and routinely risked $500 to $1,000 per trade, which meant risking 3% to 7% per trade. One bad day could wipe out weeks of gains. 3 consecutive losses could destroy months of progress. She was constantly stressed, constantly worried, constantly adjusting her stops to avoid taking losses she couldn't afford. We dropped her risk to $75 per trade, exactly 0.5% of her account. Same setups, same market conditions, same analysis methods, but suddenly she could survive 20 consecutive losses and still have 85% of her capital intact. Her equity curve flattened initially as her position sizes shrank, but then it started climbing steadily because she could finally follow her rules without emotional interference. The amateur thinks small position size means small profits, but this reveals a fundamental misunderstanding of how professional trading works. The professional knows small position size makes big decisions easy. When you're not choking on position size, when a single trade can't materially damage your account, you can actually follow your rules. You can cut losses fast because the loss doesn't hurt. You can hold winners because you're not scared of giving back profits. You can wait for proper setups because you're not desperate to recover from oversized losses. This psychological freedom is priceless and compounds over time. Consider Tom, who loved conviction trades. He'd see a breakout and buy 200 shares because it felt like a sure thing. His stop was a suggestion, not a command. When earnings leaked early and the stock gapped through his level, he froze. The loss became 4 times what he planned because there was no plan. Size made rational action impossible. If Tom had started with 1R set to $50, that same gap would still sting, but it wouldn't cripple him. You cannot control gaps or unexpected news. You can control how exposed you are when they occur. For these 7 days, narrow your mission completely. Before the market opens, write down your account size, your 1R, and your maximum portfolio risk for the day. Keep total open risk under 2% across all positions. During the session, only take trades where you can define invalidation clearly on the chart. If you cannot point to the exact price that proves you wrong, you do not have a trade. Enter only after you calculate shares using the distance to your stop. Place the stop immediately after entry. Walk away for 5 minutes. Let the order harden into reality before you start second-guessing yourself. Track everything in R units, not dollars. If you lose 1R 3 times, you are down 3 units, not down $150. If you win 2R once, you are up 2 units. This language keeps you calm and focused on process rather than money. It also exposes performance patterns. Do your winners pay at least 2 to 3 times your 1R on average? If not, the problem is exits or entries, not size, and we'll address that in the coming weeks. For now, your singular goal is 20 consecutive trades where every loss is exactly 1R or less. If you break this rule, stop trading for the day and reset tomorrow. Expect boredom and welcome it as your edge. Boredom means you're not forcing trades to justify your screen time. The amateur equates excitement with opportunity and action with progress. The professional equates clarity with opportunity and patience with profit. Clarity appears when you know your 1R, your stop, and your size before you click buy. Doing nothing until those 3 elements align is often the most profitable decision you'll make all day. Waiting is a position. Cash is a position. Being flat is a position. This mindset pays dividends when the real move arrives, and you still have capital, courage, and clarity to participate fully. Practice with tiny size if needed during these first 7 days. Trade 1 share or use a simulator for 3 days if you must. Your goal is not profit this week. Your goal is habit formation. Each morning, write this commitment. I risk 0.5%. I place hard stops at invalidation. I size by distance to the stop. Each evening, grade yourself on 1 item only. Did I keep the promise? Professional identity is built through repetition. not inspiration. Small steps, repeated and daily, create lasting transformation. Position sizing is the foundation that makes everything else possible. Without it, the best entry timing becomes irrelevant because you can't psychologically handle the trade. The perfect exit strategy becomes useless because you're too scared to execute it. The most sophisticated analysis becomes worthless because you can't afford to be wrong. Days 1 to 7 are purely about making this risk math automatic, unconscious, non-negotiable. But position sizing only protects you if you're entering at the right time. Most traders enter too early, before the market confirms their thesis, getting chopped up by false signals and premature moves. That precise art of waiting for confirmation, trading like a detective rather than a fortune teller, is exactly what we fix in week 2. Amateur traders are fortune tellers. They predict breakouts before they happen, anticipate reversals at the first sign of weakness, and enter positions before the market confirms their thesis. They look at charts and see what they want to see, projecting their hopes onto price patterns that haven't yet proven themselves. They buy stocks building bases, hoping to catch moves from the absolute bottom. They short into strength, expecting immediate reversals. They enter at support levels, assuming they'll hold simply because they look strong on the chart. This predictive approach feels intelligent and sophisticated, but it's actually the fastest way to lose money consistently, because markets don't care about your predictions, only your positioning when reality unfolds. Professionals are detectives. They wait for evidence, demand proof, and only commit capital after the market confirms their thesis through actual price action and volume. They don't predict what will happen next. They observe what is happening now and align themselves with demonstrated momentum rather than anticipated momentum. When a stock approaches a breakout level, they don't assume it will continue higher. They wait for the breakout to prove itself through follow-through action, volume expansion, and sustained price movement above the critical level. When a trend appears to be reversing, they don't immediately bet against it. They wait for the reversal to establish itself through multiple sessions of contrary action that overwhelm the previous trend's momentum. Jesse Livermore learned this lesson through expensive experience early in his career. He had developed exceptional ability to read tape action and identify stocks building energy for significant moves. His analysis was often brilliant, his directional calls frequently correct, but his timing was consistently premature. He'd see a stock consolidating in a tight range, building what he called a head of steam, and buy immediately, hoping to catch the entire move from the very beginning. The stock would fake him out, break lower first, stop him out with a small loss, then rally powerfully without him. He was absolutely right about the direction and magnitude of the eventual move, but wrong about the timing of his entry. His predictions were accurate, but his patience was lacking, and the market punished him for this impatience repeatedly. The solution came through understanding what Livermore called pivotal points, specific price levels that, when broken with conviction and volume, signal the line of least resistance for the next significant move. These aren't arbitrary support and resistance levels drawn by analysts or random round numbers that look important on charts. They're price points where the character of supply and demand fundamentally shifts, where the balance of power between buyers and sellers tips decisively in one direction. Above a pivotal point, buyers demonstrate control and willingness to pay progressively higher prices. Below a pivotal point, sellers dominate and force prices systematically lower. The key insight that transformed Livermore's career. You don't buy the break itself, you buy the confirmation of the break. Days 8 to 14 focus exclusively on developing this confirmation discipline through a systematic protocol that removes guesswork and emotion from entry timing. Pivotal point identification requires recognizing clear technical levels where supply and demand dynamics change. Prior highs that have contained rallies for weeks or months, trend lines that have defined the slope of moves for extended periods, or consolidation breakouts where stocks have built energy through sideways action. These levels matter because they represent psychological and technical battlegrounds, where one side finally overwhelms the other with decisive action. The two-step confirmation process ensures you only enter after the market proves your thesis correct through observable evidence. Step 1 is price action confirmation. The break must hold above the pivotal point with a strong close, well above the level. not a marginal break that immediately fades. A stock that breaks $50 and closes at $50.05 shows weakness. A stock that breaks $50 and closes at $50.75 demonstrates conviction. Step 2 is character change confirmation. Volume must expand at least 30% above the 20-day average. Daily ranges should widen as participants become more aggressive, and the tape should feel different, more urgent, more decisive than during the consolidation period. The 2-day rule provides crucial protection against false breakouts that initially look convincing but quickly fail. After any breakout above a pivotal point, give it exactly 2 trading sessions to prove sustainability. If the stock fails back below the pivot level and cannot reclaim it by the close of the second day, exit immediately without debate or hope. This rule prevents holding failed breakouts that turn into significant losses. Many breakouts fail within 48 hours as early buyers take profits and late sellers finally capitulate. Stocks that hold above pivotal points for 2 full days typically continue much higher because they've survived the initial test of weak hands. Entry timing becomes systematic rather than emotional once you understand confirmation principles. You buy the first strong close above the pivotal point if volume and character confirm the move. Or you buy a controlled pullback to the breakout level that holds and reverses, using that level as your stop. Never chase breakouts that have already moved significantly from the pivot. Never buy breakouts without volume confirmation. Never enter before the close of the breakout day because intraday breaks often fade by session's end. Marcus demonstrated this approach perfectly with a stock consolidating between $45 and $48 for 3 weeks. When it broke $48.50 on volume 200% above recent averages, Marcus didn't chase the initial thrust. He waited for confirmation. The stock closed at $48.85, well above the pivot. The next day, it pulled back to $48.20, held, and turned higher on rising volume. He bought at $48.30 with a stop at $47.80, risking 50 cents per share. Using his 1R of $50 from week 1, he bought 100 shares. The stock ran to $56, delivering an 15. 4R winner. The amateur who grabbed $48.50 got shaken out at $48.05 and missed the real move. During days 8 to 14, adopt an alert-first workflow to enforce patience. Mark 3 to 5 names near pivotal points each morning. Set price alerts at the levels, plus secondary alerts for retests. Don't watch ticks because watching breeds prediction while alerts enforce confirmation. Limit yourself to 2 trades per day maximum. Keep total open risk under 2% of equity, and take 0 trades lacking both confirmation steps. Record each trade in R multiples, screenshot setups and fills, and grade yourself nightly on 1 criterion. Did you trade confirmation or prediction? Expect this confirmation approach to feel uncomfortable initially. You'll watch stocks break out and think you're missing opportunities. You'll see moves begin without you and feel too conservative. This discomfort is normal and necessary. Professional traders understand that missing the first 10% of a move in exchange for confirmation is excellent business. The stocks that pull back and hold after breakouts typically deliver much larger gains than those that immediately fail. Your job isn't catching every move, but catching the right moves with favorable risk-reward parameters. By day 14, confirmation should feel natural rather than forced. You should automatically wait for closes above pivotal points, instinctively check volume before entering breakouts, and naturally apply the 2-day rule against false signals. This patience and discipline create the foundation for advanced position management techniques in week 3. But confirmation alone, while necessary, isn't sufficient for building substantial trading profits. Single entries and exits, even when perfectly timed, limit profit potential to initial risk-reward parameters. Week 3 reveals how professionals transform single good decisions into profitable campaigns through systematic position building that multiplies gains while controlling risk. Here's the paradox that separates professionals from everyone else. To pyramid correctly, you must first master the art of cutting losses faster than you add to winners. This seems completely backwards to most traders who naturally want to add to positions when they're losing to reduce their average cost while taking quick profits on winners before they disappear. Amateurs average down on losers because it feels mathematically logical and psychologically comforting. If you bought at $50 and it drops to 45, buying more shares at 45 reduces your average cost, making break-even seem more achievable. They take quick profits on winners because gains feel fragile and temporary, while losses feel permanent and fixable through patience and additional capital. Professionals do the exact opposite with surgical precision. They cut losses immediately when their analysis proves wrong, treating failed positions as information rather than opportunities for cost averaging. They add to winning positions systematically when the market proves their thesis correct through sustained price movement, expanding volume, and technical follow-through. This approach treats winning positions as campaigns to be built rather than lottery tickets to be cashed quickly. Jesse Livermore's greatest insight wasn't about individual trades or perfect entry timing. It was about campaigns. One good idea, properly managed through systematic position building, could fund months of small losses and generate the type of wealth-building profits that compound over time. But this only worked because he added to strength, never to weakness. The professional pyramiding protocol transforms single trades into profitable campaigns through 4 distinct phases that must be executed in sequence. Phase 1 establishes the base position using your confirmation rules from days 8 to 14. This initial entry is your reconnaissance mission, designed to test your thesis with minimal risk while positioning for larger gains if the market proves you correct. Use exactly 1.0 R of risk with a tight stop at technical invalidation. This pilot position gathers intelligence about the stock's character and the market's appetite for your idea. If this base position gets stopped out quickly, you've learned valuable information with minimal cost. Phase 2 focuses exclusively on adding to proof, never to hope or comfort. You only add when the market demonstrates your analysis was correct through observable price action. Add at the first pullback to the breakout level that holds and reverses with volume, showing the level has transformed from resistance to support. Add at fresh highs after tight consolidation periods of 3 to 5 bars, indicating renewed momentum building. Add at clear trend, continuation patterns like flags or pennants that break with expanding volume. Every addition must be earned through market behavior that confirms your thesis, never simply because you want larger profits or have available capital. Phase 3 requires scaling additions smaller than previous entries to maintain risk control as position size grows. Your initial position risks 1.0 R. Your first addition should risk 0.7 R. Your second addition should risk 0.5 R. This declining scale ensures that later additions, which carry higher prices and potentially less favorable risk-reward ratios, don't overwhelm your position if the campaign fails. The key principle: each addition must be smaller than the previous one, and you should rarely exceed 3 total entries in any single campaign. Phase 4 implements systematic stop management through ratcheting, moving stops higher after each addition to lock in gains and reduce total position risk. After adding to a winning position, immediately move your stop on the entire position to a level that reduces your total risk back to approximately 1.0 R. This ensures that even if the campaign fails after multiple additions, your maximum loss remains similar to a single failed trade. Consider this mathematical example. A stock breaks out at $50, and you buy 100 shares with a stop at 47.5, risking 47.5, risking 250 or 1.0 R on a 50,000 account. The stock runs to $54, pulls back to $51, holds with volume, and reverses higher. You'd 70 shares at $52 and move your stop on all 170 shares to 50,000 account. The stock runs to $54, pulls back to $51, holds with volume, and reverse higher. You add 70 shares to $52 and move your stop on all 170 shares to 49.50. Your total position value is now 170 times 52 equals 8,840. 170 times 52 equals 8,840. But your maximum loss is 170 times 5249.5 equals 425170 times 5249.5 equals 425, approximately 17 R despite the larger position. If the stock continues to $60, you might add 50 more shares and ratchet stops to $52, ensuring the entire campaign risks only 1.0 R while controlling a position worth over 13,000. The amateur sees a winner and makes one of two mistakes: taking quick profits to lock in gains, or making one large addition that risks everything on continued success. The professional builds campaigns systematically, letting the market's demonstrated strength determine both timing and size of additional entries. This approach requires exceptional patience because profitable additions often come days or weeks after initial entries, and the temptation to either take profits or add impulsively grows with each passing session. Days 15 to 21 focus on developing campaign mentality through a specific challenge. Force yourself to wait exactly 24 hours between any trade, win or lose. This isn't punishment for overtrading, but deliberate training of your most valuable skill: patience. The 24-hour rule forces you to think in campaigns rather than individual trades. Plan additions before making initial entries, and resist the impulse to constantly adjust positions based on short-term movements. During waiting periods, study existing positions like a general studying battlefield conditions, analyzing volume, range expansion, and sector strength. By day 21, you'll understand viscerally what Livermore meant. It never was my thinking that made the big money for me. It always was my sitting. The ability to sit with winning positions, add to them systematically, and ride them for substantial gains, while cutting losses quickly represents the essence of professional trading psychology. Your transformation from amateur to professional concludes with this advanced skill, but your career as a systematic campaign builder begins now. After 21 days, you are not the same trader who started this journey. You've experienced what Livermore called the tape education, learning to read the market's true language beneath the noise of predictions, opinions, and emotional reactions. The transformation runs deeper than new techniques or improved results. Your entire relationship with risk, uncertainty, and decision-making has fundamentally shifted from amateur impulse to professional discipline. You now think in probabilities rather than certainties, in campaigns rather than individual trades, in mathematical expectations rather than emotional hopes. The person who began this transformation 3 weeks ago was driven by hope and fear, making decisions based on emotion and reacting impulsively to market movements. That amateur has been replaced by someone who operates from calm, calculated execution. The amateur you were 3 weeks ago would look at your new approach and call it boring. One position at a time instead of multiple simultaneous trades, mandatory waiting periods between entries, position sizes that feel insignificantly small. Where's the excitement, the adrenaline, the thrill of big wins and dramatic comebacks? This reaction reveals exactly how far you've traveled. The need for excitement was the amateur's primary motivation, and it was also the primary cause of consistent losses. Excitement in trading comes from uncertainty, from risking too much, from hoping rather than knowing, from gambling rather than investing. That's exactly the point. Professional trading isn't exciting, it's effective. The most successful traders describe their daily routine as methodical, systematic, even mundane. They follow checklists, execute predetermined plans, and make decisions based on mathematical probabilities rather than emotional impulses. The excitement comes from long-term results, not short-term thrills. That boredom you now feel is your edge, meaning you're not constantly chasing the next big thing or getting chopped up by market noise. You've internalized the trinity of professional trading that separates winners from the losing 90%. Position sizing that lets you survive any single mistake forms the foundation of everything else. When you risk exactly 0.5% per trade, no individual decision can materially damage your account or your psychology. This mathematical precision removes the emotional pressure that destroys rational decision-making. You can cut losses quickly because the loss doesn't hurt. You can hold winners because you're not scared of giving back profits. You can wait for proper setups because you're not desperate to recover from previous mistakes. At 0.5% risk per trade, you can survive 200 consecutive losses before your account reaches zero, a statistical impossibility that provides profound psychological freedom. Loss cutting that prevents small problems from becoming disasters represents the second pillar. Amateurs turn small losses into large ones through hope, denial, and position averaging. You now understand that a stop loss isn't a suggestion. It's a mathematical certainty that executes automatically without debate. When your trade thesis is invalidated, you exit without hesitation or emotion. This discipline preserves capital, prevents compounding losses, and keeps your mind clear for the next high-probability setup. Every loss becomes tuition in your continuing tape education, providing valuable information about market character and personal psychology. Being wrong about direction doesn't make you wrong about process. Patience that lets you wait for the market to come to you completes the trinity. This isn't passive waiting, but active preparation, combined with disciplined restraint. You study charts, identify pivotal points, calculate position sizes, and set alerts, but you don't trade until confirmation appears. Waiting is a position. Cash is a position. Being flat is a position. This mindset transforms trading from constant activity to selective participation. You trade the market's schedule, not your own. You participate when conditions favor your approach and step aside when they don't. This strategic patience prevents whipsaws, reduces unnecessary transactions, and ensures you're only engaging in the highest probability setups. Here's the secret that makes this transformation permanent. These aren't just trading rules, they're life principles. The discipline you've built transfers to every area of your existence. You've become someone who thinks before acting, plans before executing, waits for the right opportunity, instead of settling for any opportunity. The same mathematical thinking that governs position sizing improves financial planning. The same confirmation discipline that governs entries improves business decisions. The same patience that governs trading improves relationships and career choices. The emotional control required to cut a loss or wait for a confirmed setup spills over into managing frustrations, making rational choices under pressure, and focusing on long-term goals rather than short-term impulses. Your daily operational framework for permanent transformation begins with 3 pre-market non-negotiables. Maximum portfolio risk stays under 2% of equity across all open positions, ensuring that even if every current trade fails simultaneously, your account survives intact. Identify 3 to 5 names near pivotal points using your confirmation criteria, focusing on quality setups rather than quantity opportunities. Set stops before the opening bell while your mind is clear and emotions are calm, removing the temptation to adjust levels when positions move against you. During market hours, 3 rules govern all activity. No trigger, no trade means every entry must meet your confirmation requirements without exception. The 2-stop rule requires stopping all trading after 2 full 1-hour losses in any single day, preventing emotional revenge trading that destroys accounts. Remember that waiting is a position, often the most profitable one you can take. When you hit the 2-stop rule twice in a week, step away for 24 hours and study your process. Post-market analysis cements lessons through systematic review. Journal every trade with 3 components: your thesis before entry, your execution during the trade, and your emotional state throughout the process. Grade your emotional control from 0 to 10, tracking patterns that reveal psychological strengths and weaknesses. Screenshot pivotal points and significant setups, whether you traded them or not. Building a visual library of market behavior. Update your risk calendar using this color system: red for rule breaks, yellow for borderline judgment calls, green for procedural excellence. If your average winner isn't at least 2R, your exits need work. If your loss distribution shows any worse than -1, 3R without gaps, your execution slipped. You will still face drawdowns because professionals don't avoid pain, they meter it. When equity dips 6% from highs, cut size by half until you post 5 green process days. This isn't punishment, it's calibration. Every prevented larger loss funds future campaigns. Capital preservation is option premium on opportunity. The transformation is complete when you realize you're no longer trying to beat the market, you're simply participating in it intelligently. You don't fight the market or try to prove it wrong. You listen to what it's telling you through price action and volume, then align your positions with demonstrated momentum rather than predicted direction. You've joined the 10% who understand that trading isn't about being right, it's about being profitable. Amateurs need to be right to feel successful, leading to ego-driven decisions that prioritize validation over profits. Professionals focus exclusively on profitability, treating individual trades as data points in larger statistical samples. They can be wrong 60% of the time and still generate substantial returns through superior risk management and position sizing. Your mindset has shifted from predicting to confirming, from hoping to executing, from fear to calculated confidence. Your 21-day journey ends, but your professional career begins now. The habits you've built, the discipline you've developed, and the identity you've transformed create the foundation for decades of consistent profitability. The market will continue testing your resolve with false breakouts, unexpected reversals, and emotional challenges designed to separate amateurs from professionals. Your response to these tests, guided by the principles you've internalized, determines whether this transformation becomes permanent or temporary. The tape is still speaking its ancient language of supply and demand, fear and greed, strength and weakness. The same opportunities that created Livermore's fortune exist today, waiting for those with eyes to see and discipline to act. Your professional career starts with your next trade. Cut losses fast, size small, wait for confirmation, own your process. The tape is still speaking. Are you ready to listen?